Hello, everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheikh Sisi, your tutor and your mentor. Today, we are going to focus on financial instruments. We are going to continue where we stopped the previous class. So basically, today we are going to look at the concept of the preference shares, whether we are going to account for it as equity or whether we are going to account for it as a liability, as a debt. Alternatively, we are going to look at the interest and dividends content of IFRS 9. Then finally, which is more important for today's session, we are going to look at how we can split between the debt and equity when we are talking about the compound financial instruments, when we are going to look at the convertible loan note, because it has the option to convert a loan into X number of shares in X entity, for example. So basically, we are going to look at the equity element and we are going to look at the debt element and how we can calculate using the initial recognition as well as how we can account for it subsequently in the financial statement. So basically, these are what we are going to cover for today's session. So now we are going to start. We are going to look at preference shares, but before going to preference shares in detail, I just want to use this opportunity to give a brief background about IAS 33, which is earnings per shares. So basically, we are going to look at the types of shares, and when we are talking about shares, in normal term, it represents a unit of ownership in a company. When we are talking about shares, it means it can give you the right to own some portion within a specific company. So that's what we are referred to as a share. We have two types of shares for this session. We have the preference shares and also we have the ordinary shares. So now let me explain the ordinary shares, then we can look at the preference shares later. So we are talking about the ordinary shares. So now when we talk about the ordinary shares are the main, ownership of a company. The ordinary shareholders, they are the actual owners of the company. While the ordinary shares are the actual owners of the company, we need to look at the key rights of the ordinary share. We need to look at it, the key rights of the ordinary shareholders. So the major right about ordinary share, which is more important, is the right to vote, the voting right. Being an ordinary shareholder will give you the right to vote during the annual general meeting. So voting right during the AGM, the annual general meeting. Another right is that being an ordinary shareholder will give you the right to receive a dividend if it is available. So right to receive dividend if applicable. Another right of being an ordinary shareholder, it will give you the right to a residual profit. A residual profit. Then also, another right of being an ordinary shareholder, it will give you the right in the event of liquidation, you can able to receive some portion of the assets in the event of liquidation. So in the event of liquidation, will receive some portion of assets. Then finally, which is very important right of an ordinary shareholder, is that you can transfer your shares at any point in time. Right to transfer shares. So basically, because of these rights, the ordinary shareholders are considered to be the main ownership of the company. So now, what are the advantages and disadvantages of being an ordinary share? Because we need to understand that as well. We need to understand the advantages and disadvantages of ordinary shares. Now, let me look at the advantage first before going to the disadvantage. Advantages. One of the advantages is that it will give a control right. Control right. Being an ordinary shareholder, you will have controllability in X company. Now, for example, if I purchase, 10% of company X ordinary shares, it means I have 10% voting right in any decision that that particular company is going to make. So when they are going to make that particular decision, my input will be needed. My input will be required. My own suggestion, my own recommendation, is highly needed and recommended. So basically, being an ordinary shareholder, you will have the right to controllability. Another right, another advantage of being an ordinary share is that you will have the potential to unlimited dividend. You will have the right, you will have the potential to receive unlimited dividend. As far as you are an ownership, you have the stake in X, Y, and Z company, you will have the right to receive dividend at any point in time, provided if dividend will be given or will be issued out to that particular on that particular period or year, whichever. Then also being ordinary share, another key benefit for capital appreciation, which is very much important because you can purchase, you can buy shares today for 10, for example, or one share for $1. Then in the next 2 to 3 years, the share price has increased significantly. So you can benefit from capital appreciation. So now, let's stop for the example with regards to this one. Now let's look at the disadvantage. The disadvantages of being ordinary shareholders. One of the disadvantages, dividend is uncertain. When you are going to look at IAS 33 earnings per share, we are going to look at the condition, and also for financial management, the dividend decision making. We are going to look at it whether the company should issue out dividends or whether the company should use the dividend for future growth or for whichever strategic management decision. So it is very important we understand the content of dividend. Then also another disadvantage, in the event of liquidation, the ordinary shareholder will be the last to consider for settlement. So last to consider in the event of liquidation. In the event of liquidation, they will be the last shareholders to consider. Then also it is of high investment risks because at any point in time, the share value can fall significantly, which will result to a significant risk of investment. So basically, this is just a few bullet points so you can able to compare and contrast between the ordinary shares and the preference shares. So now we are going to look at preference shares. Now, what is preference shares? Now, when we are talking about preference shares, um, preference shares are shares, that give additional preferential rights over the ordinary shares. So it provides additional preferential right over the ordinary shareholders. Very important concept. Very important concept. It provides additional preferential rights. So what are these additional preferential rights that the ordinary share did not have access to? One is the priority to pay dividend. One, let me see, advantages, right? Priority, you know, in the event of liquidation. In the event of liquidation, right? They will be considered before the ordinary shareholders. Very important point. In the event of liquidation, the company can settle the preference shareholder before the ordinary shareholder. Then priority to receive dividend. The preference shareholders have the priority. The preference shareholders have the priority to receive dividend as compared to that of the ordinary shareholders. So that's why, when we are talking about preference shares, it means these shares provide preferential, additional, right over that of the ordinary share. So now let's look at the feature of preferential shares. Feature of preference shares. One of the feature is that fixed dividend rate. The dividend rate is fixed. Also, it has limited or no voting right. It's low risk. Then potentially it can be, it's hybrid of equity and debt. When we are talking about hybrid of equity and debt, it means, owning, having a preference share, you can have the right to be an equity holder or you can be a debt holder. So that hybrid value of preference shares, it provides additional, rights over that of the ordinary shareholders. So basically, with this distinction, we are going to look at how we can account for the preference shares. We are not going to look at ordinary share in this context for now. We are going to look at how we can account for the preference shares, because content of the preference shares can be a financial liability. So now, let's go through the process. If irredeemable, now we have two types of preference shares. We have redeemable preference shares, we have irredeemable. When we are talking about irredeemable, it means once the shares have been purchased, they cannot be redeemed. While for the redeemable, they can redeem the shares at any point in time, or based on the contract agreement. So now, if irredeemable preference shares contains no obligation to make any payment, either of capital or dividend, they are classified as equity. If there is no obligation, that's why we refer to it as irredeemable preference shares, because there will be no obligation. And if there is no obligation, then we can classify them as an equity. If preference shares are redeemable, very important concept. If they are redeemable or have a fixed cumulative dividend, now for example, based on the contract agreement, on annual basis, the preferential shareholders, will receive X rates of dividend on annual basis. So because of that fixed cumulative dividend, we can't account for it as equity, because the company has an obligation to meet. The company has an obligation on annual basis to pay fixed cumulative dividend to X preferential shareholders. So if that is the case, it means the company has a liability, the company has a present obligation to settle this fixed cumulative dividend. So if that is the case, we can classify this particular preferential shareholders as a financial liability instead of equity. The key element is that where there is an obligation, the instrument represents a liability. Where there is an obligation, the instrument, represents a liability. Very clear, very important concept to know. Now, some preferential shares are irredeemable, in which case they are classified as equity if they are irredeemable. When a preferential share provides for mandatory redemption, if it is compulsory based on the agreement that you need to redeem this share, for a fixed or determinable amount at a fixed or determinable future date, or gives the holder the right to require the issuer to redeem the share at or
after a particular date for a fixed or determinable amount. The instrument meets the definition of a financial liability, and it is classified as a financial liability. So basically, we need to look if the agreement on the share document contains the right, the mandatory redemption, or a fixed, cumulative dividend payment system within the share agreement, then it means that particular preferential share can be classified as a redeemable preference shares, which can be accounted for as a financial liability instead of equity. But if there is no present obligation, then that particular shares can be accounted for as irredeemable shares, and you can treat it as an equity instead of a financial liability. So we are going to look at the financial liability aspect of the preferential shares under IFRS 9. So you just need to distinguish between irredeemable and redeemable. The redeemable, we are going to account for it as financial liability. The irredeemable, we are going to treat it as equity. All depend on the controllability, all depend on the present obligation. So now let's look at interest. Nothing much about interest under IFRS 9. Interest and dividend. The accounting treatment of interest and dividend depends upon the accounting treatment of the underlying instrument itself. Equity, the dividend declared are reported directly in equity. Very clear. Dividends on instruments classified as liability are treated as interest expense in the statement of profit and loss. So don't worry much about um, interest and dividend. So now we are going to look at this example 3 so that we can loosen up before going to compound financial instruments. Very important. On 1st April, the requirements, how will these redeemable preference shares appear in the financial statement for the year ended 31st March 20x8? How will these redeemable preference shares? So now, on 1st April 20x7, an entity issue 40,000 $1 redeemable preference shares with a coupon rate of 8% at par. They are redeemable at a large premium, which gives them an effective finance cost of 12% per annum. So basically, we need to account for these redeemable shares. So now, basically, the value of the shares, values of share, the value of shares will equals to the number of shares multiplied by the share price. So basically, it will be 40,000 multiplied by the share price $1. So basically, $40,000 is the value of the share price. So now, what we are going to do in this situation, since it is preferential shares, we are going to debit bank and we are going to credit liability. So now we are going to account for the liability using the amortized cost approach because we need to calculate the finance cost and we need to calculate the cash payment. And don't forget, the cash payment will be calculated using the coupon rate, while the finance cost will be calculated using the effective finance cost rate. When we are going to look at the convertible, I'm going to distinguish clearly between the coupon rate and that of the effective finance cost or the market rate. So now let's use the amortized cost method. We have here the initial liability, the finance cost at 12% given in the question, at 12%, the interest paid at 8%, and the closing liability. So basically, year one, we're just going to do it for a single year, 31st March 20x8. Year one, the initial value is 40,000.
The finance cost will be 12% of 14,000. 0.12 times 40 will be 4,800. The interest paid will be 0.08 multiplied by 40,000 will be 3,200 minus 3,200. Then the closing liability will be 40,000 plus 4,800 minus 3,200 will be 41,600. So basically, this is how we are going to show the irredeemable shares in the financial statement. So now, the financial statement we are going to show in the statement of profit or loss. We are going to show expense of 4,800, right? And also in the statement of financial position, we are going to show a liability equals to 4,160. So basically, this is what we are going to do. So this is how we can account for this particular transaction. So nothing much to worry about. So now we are going to look at the classification of liability or equity. Nothing much about this classification. You can read it on your own. I want to start looking at the compound financial instrument, which is very much important for the examination. So now, basically, when we are talking about the compound financial instrument, a compound financial instrument is a financial instrument that has the characteristics of both debt and equity. It can be equity and it can be liability. When I'm talking about debt, it means liability. When I'm talking about liability, it means debt. So, for example, we are talking about a convertible loan. A convertible loan has the following characteristics. One, repayable at the lender option. So now, when we are talking about the convertible, it means that particular loan has the option to be exercised, whether you can convert the loan into ordinary shares, or you can't convert the loan, you want to redeem the loan at par or at premium, whichever is in the contract agreement. But basically, there is an option in the loan that that you're going to receive. That particular option is contained within the loan. So the lender has the option to exercise whether you can convert the loan into ordinary shares, or you can redeem the loan at par or as premium. First important point. Second point, the number of shares to be issued fixed at the inception date. So on the contract date, the number of shares that the loan provider will receive in the future need to be determined before the initiation of the contract. At the inception of the loan, that should be fixed. Very important point. Finally, the lender will accept a rate of interest below the market rate for the non-convertible. So now what they are saying, if without the convertible option, right? If without the conversion option, if you want to secure that similar loan nature, then it means that rate you are going to pay is what they are referring to. So you're going to accept rate below the normal market rate, below the rate without the conversion option. So these three features, you need to know them, you need to remember them, because of this feature, that's why we are going to split between the debt and the equity. So now, as the lender is allowing the company a discounted rate, because of the lender is allowing the company a discounted rate in return for the potential issues of equity, these convertible instruments are accounted for using the split accounting. We are going to split between debt and equity. Why? The basis is that the lender will accept rates below the official market rate, because the loan has the propensity to convert into ordinary shares in the future, which might be benefits for that company, for that loan provider, or it might not be benefit, depending on the current market value at the date of of exercising that particular options in X, Y, and Z company. So now, recognize both the equity and the liability. Liability or debt element as the issuer has the potential obligation to deliver cash. Equity as the investor may choose to convert the loan into shares instead. So now, why are we going to split between the debt and the equity? One reason is that the issuer has the potential obligation to deliver cash, which is obviously it meets the definition of financial liability, it meets the definition of liability. Another reason why we are going to account for the equity element is because the investor may choose to convert the loan into shares. The conversion option at the contract inception provides the right to recognize the equity element of the convertible loan note of the compound financial instrument. Very important distinction, very important concept. For every accounting standard, you need to know why we are going to account for this as equity, why we are going to account for this as liability, why we are going to account for this as expenses. The basis for every double entry, you as a student, you should try at all costs to know so that you will be on the safer side. The accounting for a convertible loan falls into two stages, initial and subsequent recognition. Now let's look at it. When we are talking about initial recognition, it means at the contract inception, how are we going to account for the convertible loan note? How are we going to account for the compound financial instrument? For initial recognition, very important concept you need to know. The liability is measured at fair value. The fair value is the present value of the future cash flow discounted using the market rate of interest for non-convertible debt. Very important concept to note. We are talking about the present value of all the future cash flows, that the interest plus the capital discounted using the market rate. So now, when you are talking about future cash flow for convertible loan notes, it contains two elements: the interest, the cash interest payment that we are going to calculate it using using the coupon rate that we are going to calculate using the coupon rate, and the capital, the redemption amount. So now we are going to use a discount factor, which is referred to as the market rate. We are going to look at it separately. Don't worry about it, right? Now, the equity element is equals to the loan proceeds less the calculated liability element. Don't worry about it. We are going to look at it. Now, when we are talking about subsequent measurement for the equity, we are not going to do any subsequent measurement until the maturity date. While for the liability, we are going to use the amortized cost to account for the finance cost as well as the interest paid and the closing liability. So now, let me just spend few minutes to distinguish between the market rate and the interest paid. Right? Now, let me deal with the interest paid first. Interest paid. Now, when we are talking about interest paid, this is calculated using the coupon rate or the nominal rate. So now, what is coupon rate? What is coupon rate? Very important concept. You need to know what is coupon rate. So now, when we are talking about coupon rate, it has two features. It is the rate stated in the contract. So this is the contract rate. The rate stated in the contract agreement. This is the rate. Very important. Another meaning of the coupon rate, it is used to calculate the actual, it's used to calculate the actual cash interest paid. The actual cash interest paid will be calculated using the coupon rate, and it is applicable to the proceeds, not the initial liability. Very important concept. When we are going to apply the coupon rate or the nominal rate, we are going to apply it to the proceeds, not the initial liability. So very important concept. So now we are going to look at the market rate. The market rate. So how are we going to look at the market? Market rate can be the effective rate. So now for the market rate, this is the interest rate required by the market for similar condition. This is what we refer to as market rate. Now, for example, if I want to secure, let's say I want to take out loan from the bank, $10,000 loan. Now, the bank will give me 10%, for example. If within the same convertible, if someone wants to take out the same amount of loan, the bank will give that particular individual the same 10% loan. So that rate is what we refer to as the market rate. Very important. Interest rate. This is the interest rate. Interest rate that is required. This is interest rate that is required by the market for similar instrument. Very important. Also, this rate includes the impact of credit risks. It includes the impact of time value of money, and it includes the impact of the current market risks. So because of these three conditions, that's on normal ground, the market rate is always higher than the coupon rate because it includes the impact of rates, the time value of money, and the current market risks. Also, if you want to secure a similar instrument, you can use that rate on normal without the convertible option. So basically, we can use this rate to calculate. This rate is used to calculate the finance cost. We use this rate to calculate the finance cost, and also it is used as the discount factor. Very important. We use the rate as the discount factor. We use the rate to calculate the discount factor. Also, to it is used as the discount factor, right? So basically, you need to know the distinction. We are going to use the market rate to calculate the finance cost, and we are going to use the market rate to determine the discount factor that we are going to discount the future cash flow to present value. Then also we are going to use the coupon or the nominal rate to calculate the cash flow, the actual cash paid. Very important concept. So now let's try to understand other concepts, which is important. An entity issues a bond debt that can be converted into shares. The bondholder has the prospect of acquiring cheap shares in an entity because of the terms of conversion are normally quite generous. That's not my key problem for now. It's obviously because if you can exercise the option, it means it will be at your benefit. If you want to convert your loan to shares, it will provide benefits for you. So you need to do this cost benefit analysis before you decided to convert that particular loan, which is fine, right? Also, it can be a negative impact because if you decided to convert the loan to equity shares, it is possible after the conversion, the performance will become involved. So nothing to worry about that. So now let's look at example one so we can able to understand the calculation properly. Now, example one, solution, right? Split the loan between debt and equity at the inception and calculate the interest expense for each year until conversion or redemption. So two requirements, we need to split between debt and equity. Then after we have completed to split the between debt and equity, we are going to account for the interest expense, the finance cost. Convertco issues a convertible loan that pays interest of 2%. So coupon rate is 2%. The market rate is 8%. The market rate equals to 8%, right? And the loan of 5 million, the proceeds, the loan amount is equals to 5,000 in I'm going to indent it in thousand. It's payable in full 3 years. So the period is 3 years. So these are the discount factors given. So basically, we need to split between the debt and the equity. So now, for the liability, this will be the present value of all future cash flow. So when talking about future cash flow, it means the cash interest payment and the redemption value. Very important. This is how we are going to calculate the um, the present value. So we need to determine the cash flow, right? So we are going to determine the cash flow. So here, for example, um, so now cash flow calculation. Year one with equals to the cash flow in year one. We are going to pay interest of um, we are going to pay actual cash interest of 2%. So 2% of 2% multiplied by 5,000 is what we are going to pay as interest for year one. Year two, also we are going to pay 2%, 2% of 5,000. Then in year three, we are going to pay 2% plus the outstanding plus the proceeds, sorry, the redemption value. So year three, we are going to pay 2%, 2% multiplied by 5,000 plus the redemption value, which is 5,000. So it will give us 5,100. So these are the cash flows. So now we are going to discount this cash flow to present value. So we are going to use here, we are going to use cash flow. We are going to use the discount factor. And this will give us the present value. Year one, the cash flow is 100. The discount factor given in the equation 0.926. The present value will be 92.6. 100 multiplied 0.926 will be 92.6. Year two, the cash flow is 100. The discount factor is 0.857. And the present value will be 85.7. In year three, the cash flow is 5,100. The discount factor is 0.794, and the present value will be 5,100 multiplied by 0.794 will be 49.4. So basically, the present value will be 92.6 plus 85.7 plus 49.4 will equals to 4227.7. So now this is the liability. So now present value, net present value. This is the liability. So now we're going to calculate the equity. The equity is equals to the proceeds minus the liability, which is the proceeds is equals to the 5,000 minus the liability of 4227.7 will give us 772.23. So basically, this is how we are going to split between the debt and the equity. So now what will be the double entry? The double entry is that we are going to debit bank with the proceeds of 5,000. We are going to credit liability equals to 4227.7, and we are going to credit equity equals to 772.3. So basically, this is what we are going to do, right? So now for year one, the question stated that we need to determine the interest expense. Nothing to worry about. So the interest expense, I'm going to prepare the amortized table so you can see it clear. Amortized cost table, right? Here, um, initial liability, the finance cost, which is asked in the question, finance cost at with percentage. The market rate percentage is what we are going to use to calculate the finance cost. I think it is 8%. So finance cost at 8%, and interest paid at 2%, and the closing liability. Closing liability. So year one, the 227.7, 8% multiplied by 4227.7 multiplied by 0.08 will give us 338.216. And the finance cost is 100 because we are going to calculate the finance cost on the proceeds, not on the liability. Then the final closing liability will be 422.7 plus 338.216 minus 100 will give us 4465.916. So basically, this is what is asked in the question. I decided to show you so you can be able to understand. We are going to use the amortized cost to account for the finance cost as well as the closing liability. You don't have anything to worry about. So basically, this is how we can split between the debt and equity and how we can account further for the equity, the liability component. For the for the equity, we don't have anything to do until the redemption date. So now we are going to look at example 2. Very important, right? The first requirement stated that what amount will be shown as financial liability and equity when the bonds are converted. So we are going to look at when we are going to convert the loan notes, what will be the debt and the equity. Then what amount will be shown in the statement of profit or loss and statement of financial position over the period of the loan. Very important, right? So now on 1st January 20X1, an entity issued 2% convertible bond. So this is the 2% is the coupon rate or the nominal rate, 2%. So we are going to calculate our cash flow using 2% multiplied by the nominal value to determine our actual cash that we are going to pay. 36,000. Interest is payable annually in arrears. The bonds are convertible at any time up to the maturity into 40 ordinary shares for each $100 of bond. Alternatively, the bond will be redeemed at par on 31st March 20X3. So January 20X1 to December 20X1 is 1 year, 20X1, 20X2, 20X3. So it's 3 years period. Similar loan convertible bond will carry an interest rate of 9.1%. So this is the market rate. So without the convertible option, this is the rate that we are going to secure a loan if we want to secure loan without the convertible option, without the convertible loan. The present value of $1 payable at the end of the year based on the rate of 2% and 9.5 as follows. So we are not going to use a discount factor of 2% because we can use the discount factor of the market value to calculate our present value. Nothing to worry about. So now we are going to calculate our cash flow. We're going to calculate our cash flow. Cash flow calculation. Right? Year one. year one, it will be the coupon 2% multiplied by the nominal value 36,000. This will give us 7,200. Year two will be 2% again multiplied by 36,000 will give us 7,200. In year three, it will be 2% multiplied by 3,600 will give us 7,200 plus the redemption value 36,000. So will give us 36,720. So this is how we are going to calculate our cash flow. So now we are going to split between the debt and equity. So we need to calculate the present value of all the liability. So liability is equals to the present value of all future cash flow. So now we are going to discount this to present value. So we are going to use here, we are going to use the cash flow. We are going to use the discount factor, which is um, at 9.1%. Then we are going to get the present value. Year one, the cash flow is 720. The discount factor given in the equation is 0.92. We are going to use the discount factor for 9.1%, not 2%. So basically, 720 multiplied by 0.92 will give us 662.4. Year two, 720 again, multiplied by 0.84. 720 multiplied by 0.84 will give us 604.8. Year three, the cash flow will be 36,720. 36,720 multiply 36,720 multiplied by 0.77. So 36,720 multiplied by 0.77 will give us 28,274.4. So basically, the net present value will equals to plus 662.4 plus 604.8 will give us 29541.6. So basically, this is the liability. So now we are going to split the equity. The equity equals to the proceeds minus the liability. The proceeds is 36,000. 36,000 minus the liability of 29,541.6. So that will give us the equity. So the double entry will equals to we are going to debit bank by 36,000. We are going to credit liability by 29,541.6, and we are going to credit equity 6458.4. So now we have split between the debt and the equity. So the next requirement, we need what amount will be shown in the statement of profit or loss and the statement of financial position. So we need to show the expense, the finance cost, and we need to show the closing liability. Simple. Right? So now we are going to prepare the amortized cost table. Amortized cost table to calculate the closing liability, the finance cost, and the cash payments. So here, initial liability, the finance cost at 9.1%. Interest paid
at 2% closing liability. Year one, the initial liability is 29,541.6. 9% of 21,549.6 times 0.091, 9.1%. So it will be 2688.2856. The interest is what? 0.02 multiplied by 36,000 will give us 720 minus 720, right? The closing liability will be 29,541.6 plus 2688.2856 minus 720 will give us 31,509.8856. Year two, 31,509.8856 multiplied by 0.091, 9.1%, will give us 2867.3995 minus 720 plus 31,509.8856 minus 720 will give us 33,657.2519. Year three, 33,657.28519 multiplied by 0.091, 9%, will give us 3062.8129. In this situation, we are not only going to minus the 720, but we need to know whether the option will be exercised or not. So you don't have anything to worry about in this particular situation. So now, if the option is not going to exercise, then we are going to minus 720 plus the redemption value, which is 36. Very good. So this will give us plus 33,657.28519 minus 36,720. So the answer will be 0 point something because of the rounded error, 0.098, whichever. So basically, in the situation where the option will not be exercised, then this is how we are going to account for it. So nothing to worry about. So now we can keep it simple in this particular situation. In our next session, we are going to look at whether the option will be exercised or not. So now, because of time, we are going to continue the following example in our next session so that you can have more time to, to go through this session and try to understand the distinction. So thank you very much for your time.